Imagine you're analyzing a massive corporation, right? And you find two completely alternate realities living under the exact same roof.
Oh, yeah. It's a classic setup for retail drama.
Totally. So in one reality, they finally cracked the holy grail of retail. I mean, their billion-dollar digital delivery machine is actually turning a profit.
Which, by the way, the entire industry has been chasing for, what, over a decade?
Easily a decade. But then you look at the other reality. The physical aisles are just emptying out as lower-income shoppers flee.
Right. Profit margins are getting squeezed, and the macro headwinds are just howling.
Exactly. So today, we're opening up the Albertsons Q1 2026 earnings receipt.
It's honestly the ultimate story of corporate friction. You know, you have this legacy business model desperately trying to transition into the future.
And the financial results we're looking at today are just the sparks flying off that friction.
Yeah, when you look at Albertsons right now, ticker symbol ACI, you are looking at the absolute bleeding edge of where the American consumer is intersecting with high-tech logistics.
And that is exactly what we are wading into on this deep dive. We're putting on our top tickers hats today, which means our approach is tailored specifically for you, the retail investor.
Right. Our mission is to cut completely through that impenetrable Wall Street jargon.
Yep. We're going to be data forward, meaning we bring the actual receipts and the specific numbers.
And we are definitely going to be opinionated. We're telling you precisely how we interpret these corporate moves.
Oh, absolutely. But most importantly, we are going to be actionable. Because if you hold ACI in your portfolio,
or even if you're just eyeing the grocery sector as like a defensive harbor in this weird economy.
Right. You can't just read the headlines. You need to know the mechanics of what is actually happening on the ground floor.
Because the headlines alone for this quarter, they're really deceptive. I mean, they paint a picture of a company stumbling.
But the underlying operational shifts tell a much more complex and, frankly, a fascinating story about capital allocation and structural survival.
I think the best way for us to frame this deep dive for you is to compare an earnings call like this to analyzing a massive family grocery receipt.
Oh, yeah. Like after a particularly chaotic trip to the supermarket. You know the exact feeling.
You get out to the parking lot, you load the bags into the trunk, and you look at the total at the bottom of the receipt.
And it is way higher than you modeled in your head. So you have to sit there behind the steering wheel and audit the tape.
You have to see exactly where every single dollar went. Like, did the coupons actually scan?
Right, or did someone sneak a premium brand into the cart when you weren't looking? What cost more than expected?
And ultimately, you look at that piece of paper and you have to make a decision.
Is it worth going back to that specific store next week? Or do you need to take your capital somewhere else?
That's the exact analytical framework we're applying today. We are auditing the Albertsons corporate receipt line by line.
Seeing if the underlying business model is fundamentally sound or if the leakage is just too severe.
So let's look at the raw data at the top of that receipt. And listeners, brace yourselves because the initial read is pretty heavy.
Yeah, it's rough. Let's start with the absolute core metric of retail health, which is identical sales, or what the industry calls ID sales.
And for Albertsons in Q1 2026, this number came in at negative 0.8%.
Which is, well, we need to define that clearly first, right? Because identical sales is a very specific piece of retail jargon.
It is. It carefully isolates sales volume specifically at stores that were open during the exact same period in both the current year and the prior year.
So like if they just built a brand new megastore in Texas last month, the revenue from that store does not count toward this metric.
Exactly. It completely strips out the noise of new store openings. It isolates the organic baseline health of the existing footprint.
But crucially, when they report this number, they also strip out all fuel sales from the gas stations they operate in their parking lots.
Right, which makes perfect sense when you think about the mechanics of a gas station.
I mean, the grocery store has absolutely zero control over the global commodity price of a barrel of crude oil.
None. If oil spikes due to geopolitical tension, their fuel revenue spikes massively.
But it completely masks how many actual boxes of cereal or heads of lettuce they are selling inside the building.
Yeah, fuel is just pass-through revenue with volatile pricing. So identical sales, excluding fuel, is the truest, most unvarnished X-ray of actual customer demand.
And for Albertsons, that organic volume shrank by nearly a full percent.
Negative 0.8%. So the actual volume of goods moving through the registers at established stores is contracting.
Okay, that leads us directly to the profitability of what they, did manage to sell. Let's look at the adjusted EPS. the earnings per share.
This came in at $0.42.
And context is everything on that figure, right?
Oh, absolutely. That $0.42 is down significantly from the $1.55 they posted in the exact same quarter last year, fiscal 2025.
Wow. So that is a material double-digit percentage contraction in the bottom line profitability generated for every single share of stock.
It's a big hit. And then we get to the broader profitability metric, adjusted EBITDA earnings before interest, taxes, depreciation, and amortization.
They reported $1.013 billion for the quarter.
Now, to the average person on the street, $1 billion in profit over a 12-week period sounds like a license to print money.
Right. But in the grocery sector, absolute dollars are basically an illusion. It is entirely about the margins.
It is a volume game played on a razor's edge. That $1.013 billion represents a 4.1% margin as a percentage of their net sales.
And what was it last year?
In the first quarter of last year, that margin was 4.5%.
Ouch. So they're squeezing less juice out of every orange.
Exactly. And speaking of margins, the one that really caught my eye on the spreadsheet was the gross margin.
Yeah, it dropped 23 basis points down to 26.6%. Now, the transcript noted this drop was, quote, excluding fuel and LIFO accounting adjustments.
Okay, wait, let's pause at LIFO for a second because we really can't just gloss over that.
Yeah, last in, first out accounting. For a retail investor trying to understand a grocery balance sheet, how does LIFO actually impact that gross margin number?
It is a critical nuance that trips up a lot of retail investors. So LIFO, or last in, first out, is an inventory accounting method.
Okay, walk me through it.
Imagine a grocery store warehouse stacking pallets of coffee. Over the last 2 years, let's say the cost they pay the supplier for that coffee has gone up steadily due to inflation.
Sure, coffee gets more expensive.
Under LIFO, when a customer buys a bag of coffee off the shelf today, Albertsons records the cost of goods sold based on the price of the most recently purchased pallet of coffee that arrived in the warehouse.
Meaning the most expensive one.
Yes, even if the actual physical bag of coffee the customer bought was from an older, cheaper pallet they bought 6 months ago.
Oh, wow. So it is just an accounting convention, not a physical tracking of individual items.
Precisely. In an inflationary environment, using LIFO means you are matching your current sales revenue against your highest, most recent inventory costs.
Which artificially depresses your reported gross margin and your net income on paper.
Yeah, it does.
But wait, why would a company willingly choose an accounting method that makes their profits look worse to Wall Street?
Taxes.
Ah, of course.
Right. Lower reported net income means a lower corporate tax bill. It preserves cash flow in the real world, even if the spreadsheet looks a little bruised.
So when Albertsons says their gross margin dropped 23 basis points excluding LIFO adjustments, what are they really saying?
They are saying, look, even if you strip away the accounting noise of our tax-efficient inventory management, the actual underlying profitability of the goods we sold still shrank by almost 0.25%.
And in a business operating on a 4% total EBITDA margin, losing 23 basis points at the gross margin line is a structural leak in the boat.
It really is.
Okay, let's unpack this. We are looking at this diagnostic landscape. Identical sales are negative. EPS is down 13 cents. EBITDA margin is shrinking. Gross margin is leaking.
It's a rough board.
So I have to ask the hard question here. When you see a drop across every single key performance indicator like this, is this a symptom of bad management?
It's the central question of the quarter.
Like, have they lost the plot on operational execution on the ground floor? Or is this entire industry just swimming upstream against macro pressures right now?
To get to the truth, we have to look strictly at the mathematical reality of two massive external headwinds that management laid out.
Okay. These were structural outside forces that dragged heavily on the balance sheet in Q1. Let's break them down. Headwind number one.
Headwind number one was a 50 basis point drag resulting from general deflation.
Wait, I need to stop you there. Deflation.
Sounds crazy.
I mean, all we have heard about for the last 3 years in the financial press, on social media, at the kitchen table, is inflation. The cost of living is up. How is Albertsons claiming they're being hurt by prices going down?
It feels completely counterintuitive, but it is deeply entrenched in how retail math works.
Okay, explain the math on that.
While the overall macro consumer price index might still feel elevated compared to 2020, inside the specific ecosystem of a grocery store, certain major commodity categories, think dairy, eggs, certain proteins, have experienced significant year-over-year price drops.
Because the supply chain shocks of previous years resolved and wholesale prices fell.
Exactly.
Okay, so a carton of eggs that cost $4 last year might cost $2.50 this year. That is great for me as a shopper.
Yeah.
Why is it a disaster for the grocery store?
Because grocery stores run on massive fixed costs. The electricity to keep the dairy cooler cold costs the exact same.
Right.
The hourly wage of the associate stocking the shelves costs the same or more. The rent for the building costs the same.
Oh, I see where this is going.
If you sell 100 cartons of eggs at $4, you generate $400 in top-line revenue to cover those fixed costs. If deflation hits and you sell the exact same 100 cartons of eggs at $2.50, you only generate $250.
Wow. You move the exact same volume of physical product, but your top-line revenue just evaporated.
This deflationary pressure effectively erased 50 basis points from their identical sales performance. They had to run just as fast simply to generate less cash.
That is a brutal mechanical reality of the commodity business. Okay, so that is 50 basis points gone due to the cost of goods. What was the second headwind?
The second, and frankly far more significant headwind, was a 100 basis point drag, a full 1% negative impact, specifically concentrated in their pharmacy sales.
And this was driven directly by the implementation of the Inflation Reduction Act, specifically the Medicare Drug Price Negotiation Program, right?
Yes.
Now, I want to be super clear with you, the listener, right now. We take zero political stance on the IRA legislation here.
None whatsoever.
We are strictly reporting the mathematical 100 basis point drag it created on Albertsons' balance sheet, just as management presented it. So looking at this strictly through the lens of a balance sheet, how does this actually work?
The math of this Medicare negotiation program acts as a mechanical drag on top-line revenue for retail pharmacies.
But I want to really dig into the how here. How does a federal negotiation program for senior citizens medication ripple out and drag down the overall sales metric of a massive grocery conglomerate?
To understand the impact, you have to understand the economic engine of the retail pharmacy and the complex web of pharmacy benefit managers, or PBMs.
Well,
The pharmacy counter sitting in the back of your local Albertsons is not just a public service. Historically, it has been an incredible driver of both revenue and foot traffic.
right, you feel sick, you go to the back of the store to pick up your prescription, and while you're walking out, you grab a gallon of milk, a box of tissues, and a bottle of Gatorade.
Exactly. The pharmacy is basically the anchor tenant of the building.
Right. So what changed?
Under the IRA legislation, Medicare has been granted the authority to negotiate significantly lower prices for certain high-spend brand-name drugs directly with pharmaceutical manufacturers.
And from the perspective of the senior citizen walking up to the counter, this is designed to result in cheaper out-of-pocket costs for their medications.
Yes, but from the perspective of the pharmacy dispensing that drug, it fundamentally alters the reimbursement math.
Because the pharmacy isn't making the drug. They are just the middleman buying it from a wholesaler and handing it to the patient.
Right. And the reimbursement they receive, the top-line revenue recorded on Albertsons' income statement, is determined by a very complex formula negotiated with the PBMs and Medicare.
Got it.
When the aggregate cost of those negotiated drugs drops, the total top-line dollar amount flowing through Albertsons registers also drops.
Furthermore, doesn't the legislation shift some of the liability for catastrophic coverage phases?
It does, which puts additional pressure on the dispensing pharmacy's margins.
So even if the pharmacist fills the exact same number of pill bottles this Tuesday as they did last Tuesday, the revenue generated by those bottles is materially lower.
Precisely. And because the grocery business operates on such thin aggregate margins, a shock to the top-line revenue of a high-dollar department like the pharmacy creates a disproportionately massive squeeze.
It just drags down the identical sales figures of the entire company.
Exactly. So let's look at the cumulative math. You have a 50 basis point drag from commodity deflation in the grocery aisles.
Yeah.
You have a 100 basis point drag from Medicare reimbursement compression at the pharmacy counter. Combined, that is a 1.5% artificial structural headwind dragging on their sales.
Which is wild. In fact, Sharon McCollam, the president and CFO of Albertsons, made a very pointed remark during the call about this.
She really did. She noted that if you strip out those two highly specific external headwinds, their identical sales would not have been negative.
They would have actually increased by approximately 0.7%, driven by strong underlying pharmacy script volume and explosive digital growth.
That completely flips the narrative of the receipt, doesn't it? It suggests that the core operational engine isn't necessarily broken, it's just driving through sick mud.
Yeah, but we can't let management off the hook entirely, because external headwinds are only half the math.
Right. The other half is what the actual shoppers are putting in their carts, which brings us to the story behind these numbers.
Exactly. Let's talk about the people walking through those automatic sliding doors.
Yeah.
What is the actual state of the Albertsons shopper right now? Because the data tells a story of a real demographic divide.
It does. And the most revealing, unfiltered commentary on this came directly from CEO Susan Morris.
What did she say?
She was incredibly candid about a severe, bifurcated consumer environment. While higher income shoppers are remaining relatively resilient, she noted a pronounced, undeniable squeeze in their lower income customer segment.
What does a squeeze actually look like in retail data? How does it manifest on the spreadsheet?
It manifests primarily in unit volume. Morris explicitly stated that they continue to see softness in units, specifically among that value-conscious demographic.
So it's not just that they are buying a cheaper brand of pasta. They are literally putting fewer boxes of pasta into the cart. The physical mass of groceries leaving the store is shrinking.
Yes, smaller basket sizes overall. But for the items that do make it into the basket, there is a massive behavioral shift happening.
Tell me about the shift.
Management highlighted that this pressured demographic is actively, aggressively trading down. They are shifting away from premium cuts of meat to cheaper proteins.
Oh, man. They are abandoning single-serve convenience items for bulk value packaging.
Exactly. It is the ultimate consumer defense mechanism.
We have all lived through periods
Yeah.
where the household budget gets tight. You know, you stand there in front of the meat cooler, you look at the price tag on the name brand ribeye,
You look at your phone to check your bank balance.
and you swap it out for the store brand chicken thighs just to make the math work at the register.
It's survival math.
You walk down the cereal aisle, you ignore the eye-level premium brands, and you reach down to the bottom shelf for the giant plastic bag of generic puffed rice.
And Albertsons is acutely aware of this shift. They aren't just passively watching their customers trade down and hoping for the best.
Right, they have built an entire strategic moat around it, which they call their own brands strategy.
Let's unpack own brands. This is industry terminology for private label. We are talking about the products that Albertsons actually owns and controls.
Like Signature Select, Lucerne Dairy, and their massive O Organics line.
Correct. And they are pushing these private labels incredibly hard to capture this trade down.
They stated a monumental goal on this earnings call, didn't they? They want own brands to reach a 30% sales penetration across the entire company.
30%.
Why 30%? Why is that the magic threshold for a grocery executive?
Because of the structural economics of a private label product, let's look at the life cycle of a typical national consumer packaged goods brand, a CPG brand.
Okay, let's say a major corporation makes a box of crackers.
Perfect. Before that box ever hits the Albertsons shelf, that CPG company has spent millions on national television advertising, digital marketing, focus groups, and elaborate supply chain distribution.
Right. And furthermore, they often have to pay Albertsons a slotting fee just to secure the premium eye-level shelf space.
Exactly. All of those massive overhead costs are baked into the wholesale price Albertsons pays for the crackers.
So the margin for the grocery store is already compressed before the customer even buys it.
Yep. Now compare that to a box of Signature Select crackers. Albertsons contracts directly with a manufacturer to produce it.
There is zero national television budget.
There are no slotting fees because Albertsons already owns the shelf. They control the entire vertical integration of that product's journey.
Wow. Because they have stripped out all that middleman friction and marketing overhead, they can price the Signature Select crackers, 20% cheaper for the stressed consumer?
At least 20% cheaper. And while doing that, they are simultaneously capturing a significantly higher profit margin percentage for themselves.
It's a brilliant hedge.
Yeah.
It is a defensive play to keep the lower income shopper from walking out the door empty-handed, but it's an offensive play for the bottom line.
It really is. If they can convince a shopper who can no longer afford the $6 national brand to buy the $4.50 store brand, Albertsons actually makes a better margin rate on the cheaper item.
That is the theory. And it is why hitting that some percent penetration metric is so critical for their long-term profitability.
But the reality is the strategy isn't bulletproof.
No, it's not.
Because during the Q&A portion of the call, when the analysts got to press management, a very uncomfortable truth emerged about where these lower income shoppers are going if the own brand's pivot isn't enough to keep them.
You're talking about the leakage problem.
The leakage problem. An analyst asked directly about market share retention among the most price-sensitive cohorts.
And CEO Susan Morris gave a remarkably unvarnished admission.
She did. She acknowledged that their most significant leakage, the customers they are outright losing, are migrating to the big players.
She specifically named Walmart and Amazon, didn't she? And pointed to pure, deep discount, price competitive retailers.
I mean, to say that out loud on a public earnings call to your shareholders has to sting.
It's basically conceding that on pure raw pricing power, you are getting beaten in the trenches.
It is a harsh reality of the current retail landscape. Walmart's entire global infrastructure, their entire corporate DNA, is built around EDLP everyday low prices.
Right. When the macroeconomic environment tightens and the lower income consumer exhausts all their credit and savings buffers, that EDLP value proposition acts like an inescapable gravitational pull.
And Albertsons, with its traditional high-low promotional model, meaning they rely on weekly sales circulars and coupons rather than flat-low prices across the board, is fundamentally struggling to hold on to the bottom tier of their customer base.
The friction is real and the leakage is measurable.
Yeah, it is.
Okay, if we pause here, the picture is incredibly bleak. The core in-store grocery business is stressed by deflation. The pharmacy is being dragged down by federal legislation.
The lower-income consumer is buying fewer items, trading down to cheaper proteins, or just outright abandoning the store to go to Walmart.
Identical sales are negative. It sounds like a broken machine. But, and this is the alternate reality I mentioned in the introduction, there was a massive, blindingly bright beacon of hope buried in this earnings report.
Oh, yes. Let's pivot and talk about the big win.
Let's talk about digital.
This is truly the bright spot, and it represents a tectonic shift for the company. Let's look at the raw growth numbers first. Digital sales grew 13% year over year in Q1.
Wait, 13% growth in a quarter where the physical store sales shrank by 0.8%?
Exactly. It is robust, double-digit, compounding growth. And because it has been growing at that clip for several years now, digital penetration has reached a major milestone.
Which is?
Digital penetration is now nearly 10.5% of total company sales.
That means 1 out of every $10 flowing into the Albertsons ecosystem is now originating on a smartphone screen or a laptop, not a physical cash register.
But growth and penetration are just top-line vanity metrics if the underlying unit economics are flawed.
True. And we need to give some historical context here to you, the listener, right? Because for the last decade, grocery delivery has been viewed by Wall Street as a necessary evil.
It was a massive, incinerating money pit. Think about the logistics.
Yeah, for 50 years, the grocery business model relied on the customer doing all the free labor.
The customer drove their own car to the store, walked the massive aisles, picked their own items off the shelf, waited in line, bagged their own groceries, and drove them home using their own gas.
And the grocery store kept the margin.
Right. Then e-commerce comes along. Suddenly, the grocery store has to pay a unionized employee to walk those aisles, carefully select the unbruised produce, pack everything into specific temperature-controlled bags,
load it into a refrigerated van, and pay a driver to navigate traffic to drop it on a porch.
The labor and logistical costs absolutely destroyed the razor-thin grocery margins.
Retailers were losing money on every single delivery order, but they had to offer it just to keep Amazon at bay.
Which brings us to the most important sentence uttered on this entire earnings call.
Let's hear it.
Management announced that their e-commerce operations, inclusive of both their first-party trucks and their third-party delivery partnerships, were officially profitable in the first quarter.
Profitable. They finally, after years of bleeding cash, tipped the digital grocery delivery apparatus out of the red and into the black.
What's fascinating here is how they achieved it. It's essentially the FedEx or UPS route optimization model finally achieving critical mass in groceries.
Because of order density, right? If a delivery van drives into a suburban cul-de-sac to drop off one single order of groceries, the fuel, the depreciation on the vehicle, and the driver's hourly wage destroy the profit on that one order.
Exactly. But because they have grown to 10.5% penetration, that same van is now dropping off 4 or 5 separate orders in that exact same cul-de-sac.
You are amortizing the fixed cost of the delivery route across multiple profitable baskets. That makes logical sense.
It does.
But what about the actual picking inside the store? How are they speeding up the fulfillment productivity without just annoying the regular physical shoppers by clogging the aisles with massive picking carts?
It is a combination of advanced software and physical micro-fulfillment strategies. Susan Morris pointed directly to massive leaps in fulfillment productivity.
Like what?
Well, the software mapping the store for the pickers has become highly optimized. It routes the associate through the aisles in the most mathematically efficient path possible, batching multiple orders together.
Oh, so if 3 different digital orders need a jar of peanut butter, the picker grabs all 3 at once when they're in aisle 6, rather than walking back and forth.
Exactly. Furthermore, they are utilizing automated micro-fulfillment centers attached to certain high-volume stores,
Where robots retrieve the center store packaged goods instantly, leaving only the fresh produce and meat to be hand-picked.
Yes, and the consumer demand for this is clearly inelastic. They specifically highlighted that flash delivery, which is their premium service promising delivery in under an hour, continues to be their fastest growing digital segment.
That proves that the modern consumer values time and convenience so highly that they are willing to absorb the premium fees required to make the service profitable for Albertsons.
It is a tremendous operational victory, but we have to look at the mathematical ripple effect of this victory because there is a very confusing data point on the receipt that we need to reconcile.
Lay it on me.
We noted earlier that the overall total gross margin for the company dropped by 23 basis points.
Right.
During the call, management explicitly cited the rapid growth of their digital sales as one of the primary drivers pulling that gross margin down.
Wait, if e-commerce is finally profitable, if it is finally operating in the black, why on earth is it dragging down the total gross margin of the company?
I want to spend a minute here because this is something we see constantly in retail transitions, and it always trips up the casual investor.
Let's call it the retail margin paradox.
Yeah.
We saw this exact same mathematical phenomenon play out with Walmart and Target a few years ago when their digital operations first exploded.
It is the perfect name for it, the retail margin paradox. To understand it, you have to strictly separate the concept of absolute profit dollars from profit margin rate.
Okay, walk me through an example.
Let's say a customer walks into the physical store and buys $100 worth of groceries. Because the customer does the labor, Albertsons might make a 30% gross margin on that basket.
So they pocket $30 in profit.
Now, let's say that same customer orders $100 online for delivery. Because Albertsons now has to pay for the picking labor and the route logistics, they only make a 25% gross margin on that basket.
But they still pocket $25 in absolute profit. It is a profitable transaction.
Yeah.
They are making money.
But the rate of profit is lower.
Exactly. The digital margin rate is structurally, naturally lower than the physical in-store margin rate because of the inherent friction of delivery.
So as digital sales grow at 13% and physical sales shrink by 0.8%, digital becomes a larger and larger slice of the total revenue pie.
You have a massive influx of 25% margin business, diluting the pool of 30% margin business.
The weighted average of the entire company's gross margin is mathematically pulled downward, creating a negative mix shift, even though the digital segment is finally generating positive cash flow.
I mean, it is a good problem to have in the grand scheme of things, because the alternative is losing that digital customer to Amazon entirely.
Exactly. But it explains the optical ugliness on the spreadsheet. The margin paradox masks the underlying operational milestone.
So if we pull all the way back and look at the diagnostic landscape we've mapped out so far, the dichotomy is incredibly clear.
The diagnosis is a classic squeeze. The core problem is that they are leaking highly price-sensitive physical customers to Walmart because their everyday shelf prices are too high.
And the core advantage is that they have built a sticky, highly engaged, rapidly growing, and now profitable digital ecosystem.
But identifying the problem and patting yourself on the back for the digital win isn't enough to appease Wall Street.
No. Management knows they can't just sit in the boardroom and watch their foundational lower-income shoppers migrate to Bentonville, Arkansas.
They need a structural, systemic fix. They need to find a way to fundamentally hollow out their own internal operating costs so they can take those millions in savings and funnel them directly into lower prices on the physical shelf to fight off the big discounters.
Which leads us perfectly into Section 3, the management response, the blueprint for the future.
Internally, they have dubbed this massive restructuring program ACI Edge, and it is underpinned by a radical integration of artificial intelligence into the core mechanics of the grocery business.
This is where we transition from auditing the past quarter to evaluating their strategy for survival. Let's translate this ACI Edge corporate strategy. This isn't just a marketing slogan, is it?
No, it is a violent restructuring of their corporate org chart. Let's start with the physical map.
What are they actually doing to the management structure?
They are drastically consolidating power. Historically, Albertsons has operated with a highly decentralized model. They had 11 separate operational divisions spread across the country.
Each with their own presidents, their own merchandising teams, their own buyers, and a significant degree of regional autonomy.
Exactly. ACI Edge is collapsing that structure. They are moving from 11 autonomous divisions down to just 4 highly centralized regions: California, the West, the South, and the East.
Now, a cynical investor might look at that and say, okay, 11 divisions down to 4 regions. That just sounds like a McKinsey consultant came in, played musical chairs with middle management, fired a bunch of vice presidents to save on salaries, and called it a transformation.
That's a fair initial reaction.
Why does this specific geographic consolidation actually matter to the economics of a box of cereal?
Because it completely revolutionizes their purchasing leverage. The beating heart of the ACI Edge strategy is a concept they call centralizing the center store.
Let's define the center store for a second. We are talking about the long aisles in the middle of the building, the shelf-stable, ambient temperature goods.
The canned soup, the laundry detergent, the paper towels, the pet food, the stuff that doesn't go bad.
Right. Now think about the logistics of the old 11-division model. You had 11 different regional buyers, all independently negotiating with Procter & Gamble for Tide detergent or with Kraft Heinz for ketchup.
They were fracturing their own scale.
The reality of consumer behavior is that the way a shopper interacts with the roll of Bounty paper towels in Boise, Idaho, is mathematically identical to how a shopper interacts with that same roll of paper towels in Miami, Florida.
There is absolutely no need for local artisanal nuance when it comes to laundry detergent.
So by centralizing
the center store, they are taking the fragmented purchasing power of over 2,200 physical supermarkets and consolidating it into one massive unified negotiating sledgehammer.
Wow. So when the centralized ACI Edge buyer sits down with the national CPG brands, they're no longer asking for regional pricing.
They're saying, we are buying for the entire United States footprint. We command a massive percentage of your national volume. Give us the absolute floor volume discount, or we will give the eye-level shelf space to our own brands.
It is a ruthless efficiency play designed to strip costs out of the supply chain. But I have a major pushback here.
Let's hear it.
One of the reasons people shop at a legacy grocer instead of a sterile mega warehouse is the local feel. If you centralize everything in a corporate tower in Chicago or Boise, don't you run the risk of completely homogenizing the store and alienating the customer who wants local products?
It is the ultimate risk of centralization.
It's like trying to remodel a 24-hour supercenter without ever locking the front doors. You risk tripping the actual shoppers who are just trying to buy their daily milk.
And it's why ACI Edge has a very specific dual mandate. They are aggressively centralizing the center store, but they are deliberately, fiercely keeping the decision-making for fresh food hyperlocal.
Give me an example of that.
Well, Susan Morris gave a phenomenal illustrative example of this exact tension on the call. She noted, quote, "I'm in Boise, Idaho today. Huckleberries are going to be a massive deal here next month, but also next month down in New Mexico, I'm going to be roasting Hatch green chili outside the stores."
That is the magic of regional grocery. You cannot centralize the procurement of Hatch green chilies with an algorithm in a corporate office.
No, you need the regional manager who understands the local palate, who knows the local farmers, to make those specific merchandising calls.
So the ACI Edge thesis is an attempt to strike the perfect difficult balance. Act like an absolutely ruthless national behemoth in the center aisles to crush supplier costs.
But act like a nimble neighborhood market in the produce and meat departments to delight the local consumer.
Okay, the logic is sound. But as Talk Tickers investors, we care about the spreadsheet. Let's look at the financials of this fix. Does tearing up the org chart and centralizing the supply chain actually generate cash?
Management is staking their credibility on it. They're targeting $200 million in incremental annual run rate savings once ACI Edge is fully implemented.
$200 million a year in structural savings is a massive number. But there is a catch, right? There's always a catch with corporate turnarounds.
The catch is the friction of time and the cost of transition.
When do they actually see the money?
The vast majority of that $200 million in recurring savings will not be realized until fiscal 2027. You don't just flip a switch and reorganize 2,200 stores overnight.
And furthermore, to build the infrastructure required to execute this, management stated they have to eat approximately $50 million in transition costs.
Which will be spread heavily across the current year, fiscal 2026, and into 2027.
So they have to bleed $50 million out of their current cash flow to pay for the severance packages, the software upgrades, and logistical mapping before they can even sniff the $200 million payoff.
Yes. And you mentioned software upgrades. The earnings transcript dedicated an immense amount of time to discussing technology. Artificial intelligence was heavily featured.
Now, every company throws AI into their earnings call right now to appease the algorithms. But ACI claims it is foundational to their turnaround.
It is not just buzzword bingo for them. They outlined 4 highly specific AI pillars that are currently being integrated into the core mechanics of the business to drive this ACI Edge efficiency.
Let's audit these 4 pillars. Pillar number 1, digital customer experience. How does AI change buying an apple on an app?
It moves the app from a static catalog to an active planning engine. They are rolling out AI-powered conversational search.
So instead of a user painfully typing taco shells, scrolling, adding to cart, typing ground beef, scrolling, adding to cart.
The consumer can use natural language. A stressed parent can open the app and say, plan a fast Taco Tuesday dinner for a family of 4 that costs under $30.
And the AI builds the cart.
The AI parses the request, builds the exact cart, actively recommends the high-margin Albertsons' own brands to ensure the basket stays under the $30 budget constraint, and seamlessly applies any relevant digital coupons from the loyalty program.
That is the definition of sticky technology. If an app saves a dual-income family 20 minutes of mental load and meal planning on a Sunday night, they are never going to delete that app to switch to a competitor's clunkier interface.
It completely locks them into the ecosystem.
Okay, pillar 2, merchandising intelligence.
This is the software engine powering that centralized center store concept we discussed. They are deploying machine learning to optimize category planning, promotional timing, and dynamic margin management.
Meaning?
This is software capable of analyzing millions of historical data points, weather patterns, and competitor pricing to tell a centralized buyer exactly what price point on a specific brand of coffee will maximize total profit dollars across all 4 regions simultaneously.
It completely removes the human guesswork from pricing elasticity.
Exactly.
Pillar 3, labor optimization. As an investor looking at the massive fixed costs of a retail workforce, this one feels like it could have the most immediate impact on the bottom line.
It is structurally transformative. They announced they are rolling out a comprehensive AI-powered workforce management platform enterprise-wide, targeting early 2027 for full implementation.
What does it do?
This system essentially automates the incredibly complex task of labor scheduling. It dynamically aligns the required labor hours directly with hyperlocal predicted customer demand.
So think about the old way. A store manager sits in the back office on a Thursday, looks at the schedule for next Tuesday, uses their gut feeling, and guesses how many cashiers they need at 2:00 p.m.
And if they guess wrong and schedule too many, labor costs destroy the daily margin.
If they schedule too few, the lines back up, customers get furious, and they abandon their carts.
Exactly. The AI removes the gut feeling. The algorithm analyzes 3 years of historical transaction data for that specific store, layers in the local weather forecast, accounts for the delivery truck schedule, and mathematically predicts the exact foot traffic flow.
It then generates an optimized schedule down to the 15-minute increment, ensuring you have exactly the right amount of labor on the floor to maintain service without wasting a single dollar on idle time.
It's revolutionary for margin control.
And finally, pillar 4, supply chain optimization.
This is using machine learning to fuse demand forecasting and inventory replenishment into a single, unified decision engine.
With the goal being to drastically lower manual intervention in the ordering process.
Right. The AI looks at the sell-through rate of milk, factors in the lead time from the dairy supplier, and automatically generates the purchase order.
So the objective is twofold. Never run out of a fast-moving item on a busy Sunday morning, and never overorder highly perishable items that end up spoiling and being thrown in the dumpster on a Wednesday.
It tightens the entire working capital loop.
Okay, here's where it gets really interesting, and where I have to step in and apply some serious investor skepticism.
Let's do it.
I am looking at these 4 AI pillars. They sound incredible. The predictive scheduling, the conversational search, the unified supply chain engine. The $200 million in structural run rate savings sounds fantastic. The centralized buying leverage, Makes total economic sense. But let's look at the brutal reality of the timeline here.
I see the trap you're pointing to.
The major $200 million savings don't actually hit the balance sheet until fiscal 2027. The AI workforce management platform doesn't even finish rolling out until early 2027. The centralization of the center store won't be fully realized until the spring or summer of next year. Meanwhile, in the present reality of 2026, they are eating $50 million in transition costs right now.
Yes.
Their lower-income consumer is fleeing to Walmart right now. And management explicitly noted in the transcript that they expect their supplier costs to rise in the second half of this current year.
It's a perfect storm.
Isn't Albertsons caught in a terrifying holding pattern? They are promising investors a high-tech, highly efficient AI-driven utopia in 2027. But they have to survive a brutal cash-burning gauntlet of a squeezed consumer and rising vendor costs in 2026 before they ever get there.
It is the defining tension of this entire investment thesis. You have identified the exact friction point. It is a highly vulnerable transition period.
They are tearing up the floorboards of their operational model while still trying to serve the daily shopper.
And to add one massive layer of risk to this precarious holding pattern, we have to factor in the human element at the very top of the corporate ladder.
Oh, the executive shakeup.
Yes. Buried in the logistics of this call was a major announcement. President and Chief Financial Officer Sharon McCollam is retiring.
Wow. Now, she has been a transformational leader at Albertsons since 2021. She is widely respected on Wall Street.
She is. She helped engineer the financial foundation that makes ACI Edge possible. And right now, right in the middle of this dangerous holding pattern you just described, right as the massive structural pivot is taking off, she is stepping down.
A CEO driving an operational overhaul is one thing. But losing the CFO, the chief architect, who designed the underlying economic model for that exact overhaul, adds an undeniable layer of execution risk.
It creates a vacuum of uncertainty at the exact moment the company needs absolute financial discipline.
And if there is one thing capital markets despise more than bad news, it is uncertainty.
Which makes this next section the absolute crux of the deep dive.
Right. If the present macro environment is tough, and the future is relying on a massive, complex, multi-year transition with a changing of the guard in the C-suite, what exactly is management formally committing to for the rest of the year?
That brings us to Section 4 on our audit, management guidance and capital allocation.
This is where we look past the Q1 results and examine the revised expectations they set for the remainder of fiscal 2026.
And crucially, how they are choosing to deploy their cash in the face of these intense headwinds.
Prepare for the guy down. When a multi-billion-dollar corporation officially revises their future revenue and profit expectations lower, Wall Street recalibrates instantly.
Let's lay out the revised numbers for the full year. Identical sales were formally revised down to a range of negative 1.5% to negative 0.5%.
Now, to be fair and precise with management's modeling, they explicitly noted that this revised negative ID sales range fully bakes in the estimated 150 basis point headwind from the IRA pharmacy legislation for the full year.
So if you read between the lines, their internal models expect the core grocery aisles to show gradual incremental volume improvement as the ACI Edge strategies begin to take root.
But they acknowledge that the mechanical drag from the pharmacy counter is going to pull the blended corporate average down into negative territory regardless.
Still, for an investor, negative is negative. A shrinking top line is a shrinking top line.
What about the profit expectations?
Adjusted EBITDA for the full year was lowered to a range of $3.55 billion to $3.625 billion.
And trailing that, adjusted EPS is now expected to come in lower, between $1.75 and $1.85 per diluted share.
They even pulled back on their investment spending. Capital expenditures, the CapEx budget, was trimmed.
Which is the cash they spend on building new physical stores, remodeling the old footprint, and investing in all those fancy AI tech pillars.
Right. They brought the range down to $1.9 billion to $2.2 billion, a reduction from their previous top-end estimate of $2.2 billion.
So look at the board. Revenue expectations are lowered, profit expectations are lowered, and future investment spending is slightly curtailed to protect cash.
The immediate glaring question is why? We know about the macro pressures, the deflation, and the legislation.
But management offered a very specific, highly strategic reason for why the EBITDA guidance had to come down so sharply.
Let's translate the corporate jargon here. Management stated that the guidance reduction was driven by surgical investments in the customer value proposition.
When a grocery executive uses that specific phrase on an earnings call, What are they actually confessing to?
They are confessing that they are actively, aggressively choosing to lower prices. When an executive says they are making investments in value, they don't mean they are buying more stock or building a better app. They mean they are taking a deliberate hit to their own corporate profit margins in order to lower the physical price tag on the shelf for the consumer.
Because they have to stop the leakage to Walmart. They looked at the data showing the lower income shopper fleeing to the big discount players, and they realized they have to fight back on price, even if it destroys their near-term EBITDA.
Exactly. Now, Susan Morris was very careful to clarify the mechanics of this during the Q&A with analysts. She emphasized that they are not engaging in broad-based panicked discounting.
They aren't just slapping a blanket 10% off sticker across the entire store and praying for volume.
Right. They are being, as she said, surgical.
What does surgical discounting look like in practice?
It relies entirely on the data engines we discussed earlier. They are using their analytics to target highly specific markets, specific product categories, and specific individual items where they know their customer base is the most intensely sensitive to price.
So if the algorithm shows that a loyal customer will abandon their digital cart or physically drive across the street to a competitor purely because a gallon of Albertsons milk is 40 cents more expensive than the Walmart milk,
Albertsons is going to proactively invest in lowering the price of that specific gallon of milk.
they will absorb the 40-cent margin loss themselves just to ensure that customer stays within the Albertsons ecosystem and hopefully buys a high-margin, own-brand box of cereal while they're there.
Precisely. It is a highly calibrated margin sacrifice. They are deliberately trading away their near-term profit margins to secure long-term customer loyalty and protect their market share during this economic squeeze.
It is an absolutely necessary defensive maneuver, but it is incredibly expensive, and it is the primary mathematical reason the EBITDA guidance had to be slashed. They are spending their expected profits on price cuts.
Okay, so let's frame the reality of the company right now. They're lowering guidance across the board. They are bracing for a tough transitional 2026.
They are fighting a federal IRA headwind. They are eating $50 million in transition costs for an unproven AI restructure. And they're actively burning their own margin to fund price cuts to fend off Walmart.
You would naturally assume that a management team in this highly precarious, cash-intensive position would be hoarding every single penny of liquidity they have in a giant corporate vault.
But their actual capital allocation strategy tells a completely contradictory, fascinating story.
This is perhaps the most critical signal in the entire earnings report. Despite the cautious macro outlook, despite the guide down, management is aggressively returning capital to their shareholders.
Let's look at the actual receipts on this. In Q1 alone, they repurchased 13.4 million shares of their own common stock, spending $226.5 million in cash to do it.
And they maintained a massive $600 million share repurchase target for the full fiscal year.
Share buybacks are a highly direct, mathematically efficient way to return value to investors.
By using corporate cash to buy shares off the open market and retire them, you reduce the total number of outstanding shares. This artificially increases the earnings power, the EPS of every single share that remains in the hands of the investors.
And the capital return doesn't stop with buybacks. They also announced a significant increase to the dividend.
A 13% hike, bringing the payout to 17 cents per common share.
Think about the psychology of that move. When a management team goes on an earnings call, formally lowers their profit guidance for the year, but simultaneously hikes their dividend payout by double digits and commits to spending hundreds of millions on share buybacks.
They are sending a very loud, very deliberate signal to Wall Street and retail investors alike.
What exactly is the signal? What are they trying to project through the noise?
The signal is absolute confidence in the structural integrity of their balance sheet. They are effectively saying, we acknowledge the current turbulence. We know we have to spend heavily on price investments and transition costs this year.
But our underlying cash flow generation is so robust and our balance sheet is so resilient that we can easily afford to execute this turnaround while simultaneously rewarding our shareholders right now.
And to be fair, the debt metrics support that swagger. Their net debt ratio stood at a very manageable 2.3 times adjusted EBITDA at the end of the quarter.
In a macroeconomic world of sustained high interest rates, where many highly leveraged legacy retailers are completely choking on their debt service payments. 2.3x is a fortress balance sheet. It is healthy.
It is the ultimate safety net. It gives management the pure financial flexibility required to execute the turbulent ACI Edge transition without having to panic about breaching debt covenants or starving the core business of capital.
So we have audited the entire receipt. We have synthesized all the moving parts, the deflationary pressures, the mechanical IRA headwinds, the consumer trade down,
The massive milestone of digital profitability, the centralized ACI Edge restructuring, the AI integrations.
the lowered guidance, the surgical price cuts, and the aggressive share buybacks. It sets up the ultimate talk tickers question for you, the retail investor sitting behind the steering wheel.
Which brings us to our final act, the bottom line.
This is where we distill the hour of analysis into an actionable, opinionated takeaway for someone who is either holding ACI stock or considering deploying capital into it.
Let's lay it out as clearly as possible.
I want you to give me the bear case first. Why should an investor look at this receipt and run away from this stock right now?
The bear case is rooted entirely in the brutal reality of the near term, and honestly, it is a highly compelling argument. The immediate 12-month future for Albertsons is heavily pressured and fraught with execution risk.
Okay, hit me with it.
You are looking at a company that just issued a formal guide down on both revenue and profits for the year. You have severe documented unit softness among lower-income shoppers who are actively fleeing your ecosystem to shop at pure discount competitors like Walmart.
That's undeniable.
You have management openly admitting that they expect supplier costs to rise in the second half of the year, which will squeeze margins even further. You are enduring deliberate structural margin compression right now because you are forced to burn cash on price cuts just to maintain market share.
That's a lot of bleeding.
And to top it all off, you are attempting to execute a massive, complex corporate restructuring that rips up the geographic reporting lines of 2,200 stores, all while your highly respected CFO is retiring.
Wow. If you were a retail investor looking for a clean, easy, momentum-driven win in the next 6 to 12 months, this is absolutely not it.
Not at all. The risks of transition failure are high, and the macroeconomic environment offers zero forgiveness.
That is a tough, sobering reality check. Okay, flip the script for me. Give me the bull case. Why should an investor hold on through the turbulence, or even view this dip as a buying opportunity?
The bull case requires a longer time horizon. It requires looking past the thunderstorms of 2026 and focusing on the structural technological foundation being poured for 2027 and beyond.
Go on.
First and foremost, achieving profitability in e-commerce is a monumental structural green flag. It definitively proves they have the logistical density to compete in the digital future without bleeding cash, solving the industry's biggest riddle.
Which Amazon and Walmart have been trying to solve forever.
Second, the fundamental logic of the ACI Edge restructuring is incredibly sound. Centralizing the center store to leverage national buying power while fiercely protecting local decision-making in the fresh departments is exactly how a legacy grocer survives the modern era.
So if management executes the AI integration, that $200 million in structural run rate savings by 2027 will provide real permanent fuel for massive earnings expansion.
Exactly. And finally, the capital allocation prove the sky isn't falling. A rational management team simply does not hike a dividend by 13% and commit to buying back $600 million in stock if their internal metrics suggest the core business model is fundamentally broken.
That 2.3x net bet ratio proves they have the fortress balance sheet required to weather this specific storm.
Yes, they do.
So we have the bear case focused on near-term transition risk and the bull case focused on long-term structural efficiency. What does this all mean for you, the listener? We promised an actionable verdict. So what is the call on ACI?
For the retail investor, ACI is fundamentally a hold for the transition story. This is not a get-rich-quick momentum trade. It is a value play that requires genuine patience.
What does that patience look like in practice?
You have to be willing to absorb a choppy, investment-heavy, and potentially optically ugly 2026 in order to reap the AI and structural efficiencies that are modeled to hit the balance sheet in 2027. It is the classic investment case of short-term pain required for long-term stabilization.
So if you believe in this management team's ability to execute the ACI Edge playbook, the current pressured valuation might offer a highly compelling entry point.
Provided you are willing to collect that 13% higher dividend as a mechanism to get paid while you wait out the storm.
But if you do not have a multi-year time horizon, or if you lose sleep over quarterly earnings misses, the near-term headwinds in the grocery sector are simply too fierce to ignore right now.
Exactly. Know your timeline before you buy.
And there you have it. The corporate receipt for Albertsons Q1 has been fully audited. We have traced the journey from a heavily pressured top line and those mechanical IRA headwinds through the genuinely impressive, industry-defying milestone of digital delivery profitability.
We mapped out the complex mechanics of the ACI Edge strategy. The AI pillars meant to save $200 million, and finally parsed through the lower 2026 guidance and the aggressive capital return that signals management's ultimate confidence.
It is the defining portrait of a massive legacy company standing at a technological crossroads, making the expensive, hard choices today in order to survive the retail landscape of tomorrow.
Well said.
But before we sign off, I want to leave you with one final, highly provocative thought to mull over, based on a very specific, fleeting phrase management used during the Q&A portion of this call. They mentioned they are conducting macro resets inside their physical stores.
Yes, the concept of right-sizing the physical space allocation based on modern consumer shopping habits, shrinking the footprint of certain declining categories and expanding the footprint of high-growth areas like functional beverages, prepared meals, and fresh proteins.
Exactly. But let's take that concept of a macro reset and stretch it to its ultimate logical extreme.
Okay, where are we going with this?
We know digital delivery is booming and is finally profitable. We know they are using AI to entirely centralize the procurement of the center store. All those packaged goods.
Right.
If nobody needs to physically browse aisle 12 for laundry detergent or paper towels anymore, because the predictive AI app just automatically reorders them and batches them into a profitable delivery route, is the traditional supermarket center aisle on its way to extinction?
It raises a profound question about the future physical footprint of American retail real estate.
Think about the trajectory. In 10 years, will your local Albertsons even have a cereal aisle that you can walk down? Or will the entire back half of that massive building just be a dark store?
A closed-off, automated fulfillment warehouse where robotic arms pick the centralized center store items for delivery.
Yeah, and perhaps the only part of the building actually open to the public is the front half. A beautifully curated, hyper-local, high-margin fresh farmers market for produce, bakery, and meats.
The logistics data and the margin profiles in this very earnings call certainly point the compass in that direction. The friction between the digital convenience of the future and the physical footprint of the past is where the entire grocery industry is heading.
Something to deeply consider the next time you are physically pushing a cart down aisle 4. Thank you for taking this deep dive with us today. Keep analyzing the raw data, keep auditing those corporate receipts, and always keep questioning the mechanics behind the numbers. We'll catch you on the next one.